A bank CEO called the most powerful investors in Silicon Valley and asked them one thing: stay calm. The call lasted 10 minutes. By the time it ended, the quote had already reached social media. By noon, withdrawal requests had overwhelmed the bank's systems. By midnight, $42 billion had left the building. The bank had existed for 40 years. Starts to clock on its last 44 hours. In the spring of 2022, Forbes added Silicon Valley Bank to its list of America's financial all-stars. The bank had tripled in size between 2019 and 2021, growing from $71 billion to over $211 billion in total assets. It held accounts for nearly half of all venture-backed technology and life sciences companies in the United States. 44% of the tech and healthcare firms that went public in 2022 ran their finances through SVB. The relationship went deeper than preference. SVB's loan agreements routinely required borrowers to maintain all of their operating accounts with the bank. Borrowers pledged their assets as collateral. The bank became, by contractual design, the sole financial gateway for thousands of startups, not because founders chose it freely every morning, but because the terms of their funding left them no alternative. Federal Reserve supervisors rated the bank's liquidity strong and its management satisfactory. Its Common Equity Tier 1 capital ratio sat at 12% at the close of 2022, 2 full percentage points above the large bank average. On paper, SVB looked like exactly what it claimed to be: the financial infrastructure of the innovation economy. What those ratings missed was the architecture beneath. The deposits that had flooded the bank during the pandemic-era technology boom, billions arriving from venture capital firms and their portfolio companies, had to go somewhere. Management put them to work. And the place they chose would determine everything that followed. Between 2020 and 2021, deposits at Silicon Valley Bank grew by nearly $130 billion. The technology sector was flush with venture capital, and the firms that received that capital parked it at SVB. Loan demand from startups didn't come close to matching that pace of growth. Management needed somewhere to put the money, and they bought U.S. Treasury bonds and agency mortgage-backed securities. Both were considered the safest assets in the global financial system, guaranteed by the federal government, no risk of default on principal. But at the interest rates available in 2020 and 2021, generating any meaningful yield meant buying bonds with long maturities. SVB purchased securities with a weighted average duration of 6.2 years, funded by demand deposits that customers could withdraw at any time. Put simply, the bank had borrowed money it might need to return tomorrow and locked it into assets it couldn't sell without a loss. By the end of 2022, the Federal Reserve had raised its benchmark rate from near zero to 4.5% in less than 12 months, the fastest tightening cycle in 4 decades. When rates rise, the market value of existing fixed-rate bonds falls. By year-end, SVB carried $17.6 billion in losses. That accounting rules did not require the bank to report on its primary financial statements. Total stockholders' equity stood at $16 billion. In early 2020, SVB's management had removed the interest rate hedges that would have limited this exposure. The decision increased short-term earnings. It also left the bank with no protection against the rate environment that was already forming. On the afternoon of Wednesday, March 8, 2023, Silicon Valley Bank issued a press release. The bank had sold substantially all of its available-for-sale securities portfolio, $21 billion in bonds, and realized an after-tax loss of $1.8 billion on the sale. To replace that capital, management announced plans to raise $2.25 billion through a combination of common stock and convertible preferred shares. That same afternoon, Silvergate Bank announced it was voluntarily liquidating. SVB's management wrote the press release as a restructuring announcement. They framed the bond sale as a deliberate repositioning, moving out of low-yield, long-duration assets and into higher-yielding short-term instruments. They presented the capital raise as forward planning, not distress. The venture capital community read it differently. SVB served a concentrated, highly networked depositor base whose members communicated constantly through private Slack channels and group texts. By 6 p.m. that evening, Moody's Investors Service had downgraded SVB's credit rating. The bank's stock fell 60% in after-hours trading, making the planned capital raise mathematically unviable before the next business day began. Peter Thiel's Founders Fund reviewed the numbers that evening. By Thursday morning, the firm had withdrawn its own funds and begun contacting every company in its portfolio. The message was direct. There was no downside to moving cash to a larger institution, while that was still possible. Thursday morning began with phone calls. Union Square Ventures contacted its portfolio companies. Coatue Management sent the same message to its founders. Sequoia Capital and Andreessen Horowitz followed. The advice moving through private channels across the venture capital network was consistent. Withdraw immediately. Move to a larger bank. Do not wait to see how the capital raise resolved. At 11 a.m. Pacific, SVB CEO Gregory Becker held a conference call with the firm's top venture capital clients. He asked them to stay calm and reminded them that SVB had supported the startup community through difficult periods before. Then he said, "If everyone is telling each other SVB is in trouble, that would be a challenge." The call lasted 10 minutes. Within the hour, that quote was moving through social media. By midday, SVB's online banking infrastructure had collapsed under the volume of digital withdrawal requests. Customers attempting to log in found the system unresponsive. Those who couldn't initiate wire transfers drove to physical branches to request cashier's checks. The bank was processing withdrawals at over $1 million every second. By the close of business, customers had attempted to pull $42 billion, roughly 1/4 of the total deposit base, in a single 8-hour window. SVB ended Thursday with a negative cash balance of $958 million. That evening, management told federal regulators to expect an additional $100 billion in withdrawal requests the following day. Washington Mutual's collapse in 2008, previously the largest bank run in American history, had taken 16 days to produce $19 billion in outflows. SVB had done more than twice that in one afternoon. California regulators closed Silicon Valley Bank at 11:15 on the morning of Friday, March 10. The FDIC was appointed receiver simultaneously. 40 years of operation had ended before the West Coast business day began. The same day, Signature Bank, a $110 billion international institution heavily reliant on uninsured deposits, lost 20% of its total deposits in hours. New York regulators closed it on Sunday, March 12. Gary Tan, CEO of Y Combinator, estimated that 30% of his portfolio companies exposed to SVB would be unable to make payroll within 30 days. Across the startup ecosystem, founders spent the weekend negotiating emergency bridge loans and calling investors for cash to cover the following Monday's salaries. The toy company Camp.com launched a site-wide 40% discount sale to generate immediate operating cash while its bank accounts sat frozen. On Sunday evening, at 6:37 p.m. Eastern, the Treasury, the Federal Reserve, and the FDIC issued a joint statement invoking the systemic risk exception to the Federal Deposit Insurance Act. Every depositor at Silicon Valley Bank, including those whose balances exceeded the $250,000 insurance limit, would have full access to their funds by Monday morning. Shareholders and unsecured debt holders received nothing. The bank's senior management was removed immediately. On March 26, First Citizens Bank acquired $72 billion of SVB's assets at a $16.5 billion discount. Roughly $90 billion in securities remained in FDIC receivership. The final cost to the Deposit Insurance Fund came to $20 billion. $18 billion of that attributable to protecting uninsured depositors. Silicon Valley Bank had a Forbes endorsement, a 12% capital ratio, and 40 years of institutional trust. None of that slowed the collapse once the first wire cleared. The mechanics of why it failed aren't complicated. Borrow short, lend long, remove the hedges, ignore the warnings. The harder question is what you do with the fact that 31 separate regulatory findings existed before the bank ever ran out of cash. The warnings were there. They just weren't acted on. If you've worked with a bank, invested through one, or simply kept money in one, the SVB story is worth understanding in detail, because the interest rate mismatch that broke SVB didn't disappear when First Citizens signed the purchase agreement. If this kind of financial storytelling is what you come here for, this channel is for you. And if there's a collapse, a crisis, or a financial system you want pulled apart, the comment section is the place to say so. Thank you. I will see you in the next video.